Greetings, friends. Ruslan and the InfoPort Finance channel are with you again. Today we're going to talk about money, and more specifically, how to make it work for you. We delve into the fascinating world of investing. Imagine you wake up and your investment portfolio is thriving. But the world of investing can seem like a maze. There are a lot of options and strategies, and nobody cancels risks. Your head can spin faster than a Vegas roulette wheel. So what's the solution? How do you stop being afraid and start navigating the world of investing with confidence? Let's be honest. One of the biggest stumbling blocks to investing is fear. Fear of the unknown. Fear of making the wrong move. Fear of losing your hard-earned money. No one wants their life savings to dissolve into thin air. Each of your rubles has the potential to grow. The key is to understand how to manage risk. That's exactly what we made this video for. Think of it as a crash course in smart investing. We'll walk you through the basic steps to help you build a solid foundation for your financial future. From defining your investment goals to understanding different asset classes, portfolio diversification and risk management, we cover everything that matters. We'll break down complex concepts into simple components using real-world examples and practical tips that you can apply today. Stop waiting in a sea of financial terms. By the end of this video, you'll have the knowledge and confidence you need to make informed investment decisions that will help you achieve your financial goals. So, fasten your seatbelts, grab your pens, and get ready to embark on this exciting journey to financial freedom. Let's go. So friends, why do you need an investment portfolio? Imagine that you have come to a fair and are going to play a game of skill. You are given some darts, and you have to hit a target. This is the principle of diversification. Putting all your money into one stock is like keeping all your eggs in one basket. A diversified portfolio reduces risk. Building a financial fortress. Think of your investment portfolio as a fortress protecting your financial well-being. A diversified portfolio is strong walls that can withstand market fluctuations. Each asset class is a different building block that contributes to the strength of your fortress. This approach ensures that your portfolio remains strong and unshakable. The power of stable growth. Stable long-term growth is the ultimate goal of building an investment portfolio. It can be tempting to chase get-rich-quick schemes, but remember, slow and steady is the key to success. A well-diversified portfolio is like a marathon runner. It's designed for steady profits over time. Paving the path to financial dreams. Let's switch to setting clear investment goals. Imagine you are planning a road trip by car. You will select a destination and plot a route. It's the same with investments. Need to know where you're going. Setting smart goals. Transform your financial dreams into concrete investment goals. And not just any goals, friends, but smart goals. Smart at the specific, measurable, achievable, relevant, and time-bound. For example, to accumulate 1,000,000 rubles by the age of 65, contributing 500 rubles each month. Can you feel the difference? Why your investment horizon matters. Your investment horizon is a map of your financial journey. It determines your strategy, attitude to risk, and asset types. A long horizon allows for more risk and time to recover. Short-term goals require a conservative approach. For example, if you're saving up for a house, you'll choose a solid investment. Remember, investing is an individual matter. Your horizon should reflect your goals and attitude toward risk. Navigating the world of risk and return. So friends, let's talk about risk. Risk is an inherent part of any investment. He who doesn't take risks is, The key is to understand the risk and manage it. Imagine you are climbing a mountain. The higher you rise, the more dangerous the fall. High returns come with high risks. Safe investments offer low returns. Find the middle ground. What is your appetite for risk? Let's talk about your personal attitude to risk, or your risk appetite. This is how comfortable you are with the volatility of your portfolio. Are you willing to take big risks, even if it means potential losses? Or do you prefer to play it safe and prioritize capital preservation? There is no right or wrong answer here. It all depends on your personal circumstances and financial goals. Select a portfolio to match your risk profile. Understanding your attitude to risk will help shape your investment portfolio. Asset allocation strategy is important. This is the allocation of investments by asset class. An aggressive investor can pick more stocks. A conservative investor will prefer bonds. Asset allocation is an ongoing process. So friends, let's dive into the very essence of risk management in investing: diversification. You've probably heard the term tossed around like a hot potato on Wall Street, but what does it really mean, and why should you care? Imagine you're in a casino and you have $100. Would you bet everything on black at the roulette table in hopes of one lucky spin? Or spread your bets by trying your luck at different games and maybe even try slot machines for a change? That's what diversification is all about, folks. Don't put all your eggs in one basket. In investing, diversification means spreading your money across different asset classes, industries, and even geographic regions. This way, you won't be overly dependent on the performance of any one investment. Diversification in action. Imagine this situation. You invested all your money in one company and it goes bankrupt. You're out of luck. But if you have diversified your portfolio, the impact of one company going bankrupt will be mitigated by the performance of your other investments. Let's say you invested in a technology company, a pharmaceutical giant, a renewable energy startup, and a real estate investment trust. Now imagine there was a sudden downturn in the technology sector. Your technology stocks could fall in value, but your other investments in various industries will help offset these losses. Diversification is like a financial safety net. It helps you weather market ups and downs with greater resilience, knowing that even if one sector of your portfolio is struggling, others can pick up the baton. Forming a balanced portfolio. So how do you create a well-diversified portfolio in practice? It's all about finding the right mix of investments that suits your risk tolerance, investment goals, and investment horizon. Start by looking at different asset classes. There are stocks. They represent a stake in publicly traded companies and offer high growth potential, but also involve higher volatility. There are bonds. Essentially, these are loans you make to governments or corporations in exchange for regular interest payments. Bonds are generally considered less risky than stocks, but offer lower potential returns. Don't forget about other asset classes, such as real estate, commodities, such as gold and oil, and even alternative investments such as private equity or hedge funds. Fine-tuning diversification strategy. Diversification is not just a random set of investments hoping for the best. It's about strategically selecting assets that complement each other and work together to achieve your financial goals. For example, if you are a young investor with a long-term planning horizon, you may want to allocate the majority of your portfolio to growth-oriented investments, such as stocks. On the other hand, as you approach retirement age, you can shift to a more conservative approach by increasing your exposure to bonds and other fixed income securities to preserve capital and earn income. Remember, friends, diversification is an ongoing process. It's not something you do once and forget. As your financial situation, goals, and risk tolerance change over time, your investment portfolio should change too. So, friends, let's dive into the exciting world of stocks. When you buy a share, you are essentially buying a tiny part of the company, becoming a co-owner, a shareholder in its success. It's like owning a slice of the pie, and as the company grows and makes a profit, so does the value of your slice. Stocks are known for their growth potential, generating significant returns over time. Think of companies like Apple, Amazon, or Tesla. Their stocks skyrocketed, turning early investors into millionaires. But remember that stocks are also the most volatile asset class, with prices fluctuating due to a variety of factors. Now let's move on to bonds, more stable and predictable relatives of stocks. When you buy a bond, you are lending money to the government or a corporation, and they'll pay you back with interest. Bonds are generally less risky than stocks and offer a fixed rate of return, known as the coupon rate. This makes the bonds attractive to investors seeking a predictable income stream, such as retirees. However, bond prices can also fluctuate, especially when interest rates change. Let's talk about real estate, an asset class that couldn't be more real. Investing in real estate means owning a physical object, whether it is a residential home, a commercial building, or a piece of land. One of the main attractions of real estate is its potential to generate rental income that provides a steady cash flow. Also, real estate tends to appreciate in value over time, especially in attractive neighborhoods. However, real estate also comes with risks, such as declining property values and landlord liability. Now let's dive into the world of commodities, the raw materials that make up the backbone of the world economy. It's about things like oil, gold, silver, wheat, and coffee. Investing in commodities can diversify your portfolio and potentially protect against inflation. When inflation rises, commodity prices tend to rise too. However, commodity prices are notoriously volatile and depend on supply and demand, geopolitical events, and weather conditions. Finally, let's talk about ETFs, or exchange-traded funds, a revolutionary tool for investors seeking instant diversification. ETFs are baskets of assets, such as stocks or bonds, that trade on stock exchanges just like individual stocks. The beauty of ETFs is that they allow you to invest in a diversified portfolio of assets with a single transaction. For example, instead of buying shares of dozens of companies in the S&P 500 index, you can simply buy an ETF on the S&P 500. ETFs come in all shapes and sizes, tracking a variety of asset classes, industries, and regions. So friends, let's talk about the delicate balance between risk and return in the world of investing. We all know the saying, "He who doesn't take risks doesn't drink champagne," right? But investing is not gambling your hard-earned money. It's about finding the right balance between potential returns and the level of risk you are comfortable with. Imagine you are walking on a tightrope. The higher the rope, the greater the potential reward, but also the greater the risk of falling. Similarly, in investing, higher potential returns usually come with higher risks. Conversely, investments that are considered more secure often offer lower returns. The key is to find a balance that matches your financial goals and risk tolerance. So how do you find that golden mean, that perfect balance between risk and return? First of all, understand your attitude toward risk. Are you a tomboy investor who is crazy about volatility, or do you prefer safer investments? Once you know your attitude to risk, align your investment choices with it. For example, younger investors with a long-term planning horizon may allocate more to growth-oriented investments such as stocks. Conversely, those approaching retirement age may opt for a more conservative approach by increasing the share of bonds and fixed-income securities. So you've built a solid investment portfolio, diversified across different asset classes, and in line with your attitude to risk and financial goals. But creating a portfolio is only the first step. After you have set your investment in motion, they need to be monitored closely. Imagine you are tending a garden, planting seeds, watering them, fertilizing them, but keep an eye out for weeds and pests. Monitoring your investment portfolio is the same, to stay informed about how your investments are performing. Identify any red flags and make the necessary adjustments to stay on track to reach your financial goals. How often should you check your portfolio? There is no magic number. Some investors prefer a hands-on approach, tracking their investments on a daily or weekly basis, while others review their portfolios quarterly or annually. The key is to find the frequency that is right for you, allowing you to stay in the loop without getting caught up in daily market fluctuations. Regular inspections are critical to identify potential problems in a timely manner, and course adjustments as needed. Think of them as preventative measures for your financial well-being. Fortunately, we live in an age where technology can make monitoring your investments simple. There are countless apps and online platforms designed to simplify investment tracking and provide a clear view of your portfolio's returns. These tools can aggregate your accounts, track your investment returns, provide real-time market data, and alert you to potential problems or opportunities. Popular investment tracking apps include Personal Capital, Mint, and Acorns. Many brokerages also offer proprietary platforms with extensive tracking and analysis capabilities. Monitoring your investment portfolio is more than just checking your account balance. It's about taking a comprehensive look at your investments to make sure they still fit your overall financial plan and attitude to risk. Regularly evaluate your investment strategy and make the necessary adjustments so that your portfolio continues to work effectively for you. Ask yourself, are your investments aligned with your financial goals? Has your attitude towards risk changed? Do you need to unbalance your portfolio? The market is constantly changing. It is full of surprises and unexpected turns. Even with the best plan, you can't let your portfolio go to waste. You must be proactive, willing to course correct and navigate the financial waters. This is where portfolio imbalance comes into play. Imagine you are trying to find balance on a toy scale. Unbalancing is about maintaining a perfect balance in your investments. It ensures that your portfolio is aligned with your financial goals and attitude to risk. Market fluctuations are not the only reason to unbalance a portfolio. Life events, such as a new job or the birth of a child, may require you to reevaluate your financial goals. For example, if you decide to buy a house, your attitude toward risk may change. You may want to unbalance your portfolio by shifting assets from riskier growth stocks to more conservative investments. Your investment portfolio should always reflect your current financial situation, goals, and attitude toward risk. So how do you unbalance your portfolio in practice? There are several different approaches. One common strategy is time unbalancing, which means setting up a regular schedule to review and adjust your portfolio. Another approach is threshold-based imbalance, which means setting certain thresholds for your asset allocation. For example, if your stocks have risen significantly in value, you can sell some stocks and buy more bonds to balance your portfolio. The key is to be consistent and disciplined in your efforts to unbalance. Portfolio unbalancing is not always an easy walk. Be mindful of taxes and investment costs. When you sell an investment at a profit, you may be subject to capital gains tax. Take into account your investment costs, such as trading fees and commissions, which can eat up your profits. Look for low-cost investment options such as index funds or ETFs to minimize these costs. Don't be afraid to seek professional help if you don't know how to unbalance your portfolio. So, friends, that's all. We covered a lot of topics today. We talked about diversification, setting smart goals, balance between risk and return, regular monitoring and rebalancing of your portfolio. The path to financial freedom is a marathon, not a sprint. Focus on your goals, be disciplined, and never stop learning. The world of investing can seem daunting, but with the right approach, it can be rewarding. You don't need to be a Wall Street financial guru to succeed. Just be willing to put in the effort, stay informed, and make smart decisions. I know what you're thinking right now. That's all great, but what do I do next? The next step is action. Revise your financial goals. Are you on the path to achieving them? Do you need to make any adjustments to your savings plan or investment strategy? Take a close look at your current investment portfolio. Is it sufficiently diversified? Does it match your attitude to risk and investment horizon? If you feel unsure, seek advice from a qualified financial advisor. He will be able to give you personalized advice and help you create a customized investment plan. Remember, the best time to start investing was yesterday. The second best time is today. Don't let fear or procrastination keep you from building a brighter financial future. If you liked the video, subscribe to our Infoport Finance channel, like it, and click the bell so as not to miss new useful videos. Share with your loved ones and friends so that they can also get valuable information. We say goodbye to you and see you again in the next video.